let's jump right into this explainer and transform these standard, sometimes dry financial formulas into your ultimate study guide. If you're gearing up for the CFA Level 1 exam, or honestly, if you just want to analyze businesses like a top-tier investor, you are absolutely in the right place. We're going to break down the math, really get into the meaning behind the numbers, and look at exactly how these concepts show up on test day. So here's our roadmap for today. We'll start with core profitability ratios, then unlock DuPont analysis. After that, we'll look at some real-world insights in AI, dive into CFA practice questions, and finally, wrap up with some crucial exam traps and tips. All right, Section 1, Core Profitability Ratios. Look, the absolute crucial point here is that this isn't just about making money, right? It's really about how well you use your resources to do it. Profitability tells us how brilliantly or, how poorly a management team converts top-line revenue into bottom-line profit. This is absolutely essential for the CFA because it's exactly how we evaluate performance against competitors and ultimately figure out how to predict future earnings. To really make this stick for the exam, let's mentally chunk these formulas into two main categories. First up, we've got our margin-based ratios. These have an income statement focus, measuring profit relative to sales. So think gross margin, which is just gross profit divided by revenue. Operating margin is operating income over revenue. And net margin, that's net income over revenue. Easy, right? Now, flip over to the return-based ratios. These look at profit relative to investment. Return on assets, or ROA, is net income divided by total assets, while return on equity, ROE, is net income divided by total equity. Organizing it this way totally demystifies the math. Moving right along to Section 2, Unlocking DuPont Analysis. Now, DuPont analysis is highly tested for a reason. It proves that ROE isn't just some magic standalone number. It's actually driven by three distinct components. Your ROE equals your net margin multiplied by your asset turnover multiplied by your financial leverage. Simply put, this shows how profitable you are, how efficient you are at turning assets into sales, and how much debt you're using to juice those returns. The CFA exam loves this because it forces you to figure out what's really driving a company's returns. Like, is their ROE high because they actually have amazing profit margins, or just because they've piled on a massive, risky amount of debt? Okay, Section 3, Real-World Insights in AI. Let's look at Infosys, a massive IT services company. The numbers here tell a really specific story. Because they operate in IT services, they naturally have an asset-light model. They don't need giant expensive factories. They need smart people. This translates to low raw material costs, but high employee costs. As a result, we see a super high operating margin and a high ROE. They're making highly efficient use of their equity because they just don't need a massive asset base to bring in incredible revenue. And honestly, this brilliantly illustrates why profitability differs so wildly by industry. If we contrast a scalable, asset-light business like Infosys with, say, a heavy manufacturing company, the story completely flips. A manufacturer has massive machinery costs, inherently lower margins, and a much higher asset base. A scalable IT firm is always going to look vastly different from a manufacturer, and that is a massive insight for the CFA. You literally cannot just blindly compare the ROA of an IT firm with the ROA of a steel plant. Context is absolutely everything. In real-world analysis, AI tools like Microsoft Copilot are total game changers. Out in the field, pros are using these tools to instantly calculate all these profitability ratios and run automated DuPont breakdowns. Instead of spending hours just crunching the numbers, AI can compare multiple companies in literal seconds and flag anomalies right away, like pointing out, hey, net margin improved from 12 to 18% specifically because of cost optimization. It saves so much time, boosts accuracy, and frees you up to focus on what actually matters, the high-level interpretation. Let's put this into practice. Section 4, CFA Practice Questions. Okay, question 1. A company reports revenue of 5,000 rupees and a net income of 750 rupees. Calculate the net profit margin. Remember the formula we chunked earlier? It's a margin-based ratio, so it's simply your bottom line divided by your top line. That's 750 divided by 5,000. Take a quick second to do the math in your head. Did you get 15%? If so, spot on. But remember, the exam is testing your deep understanding, not just your calculator skills. What does that 15% actually mean in the real world? It means that for every single rupee of sales the company makes, they keep 15 paise as pure profit after paying all their expenses. That's exactly the kind of interpretation the CFA wants you to lock down. All right, moving to question 2, return on equity. You're given a net income of 800 rupees and equity of 2,000 rupees. What's the ROE? Remember, this one is a return-based ratio, measuring profit relative to investment. So we just take that net income of 800 and divide it by the equity of 2,000. Boom, 40%, which, by the way, is a completely massive return for shareholders. But hold on, you've got to watch out here, because a high ROE isn't always good news. And this brings us right to a massive exam trap. You always have to check if that 40% was driven by actual amazing operational efficiency, or if it's just sitting on a mountain of risky debt. Think about it. If equity is artificially tiny because the company borrowed a ton of money, ROE is going to spike, but so does their risk of bankruptcy. Let's tackle question 3. Now, this is a total exam favorite, the reverse DuPont. You're given an ROE of 24%, a net margin of 8%, and an asset turnover of 1.5. Find the financial leverage. This is a classic numerical shortcut kind of problem. You basically just plug in what you know to find the missing driver. The financial leverage is exactly 2. But hey, don't worry if you couldn't calculate that instantly in your head. Let's break down exactly how we got there. You just start with the core formula. ROE equals net margin times asset turnover times leverage. Then plug in the numbers. 0.24 equals 0.08 times 1.5 times our unknown leverage. You simply multiply that 8% margin by the 1.5 turnover, which gives you 0.12. Finally, divide the 24% ROE by that 0.12, and boom, you arrive at 2. The math itself is super simple, but the real key to mastering this is to always ask yourself why those numbers changed. All right, let's wrap this up with Section 5, Exam Traps and Tips. The absolute biggest takeaway from all of this is please never just blindly memorize these ratios. Instead, really practice your interpretation. Always compare metrics across real companies in the exact same industry. Focus heavily on the DuPont analysis, because I guarantee it's incredibly high weight on the exam. And definitely be suspicious of that classic trap, a sky-high ROE that's driven entirely by a mountain of debt. Just remember the holy trinity here. Profitability plus efficiency plus leverage equals your ROE. I want to leave you with one final thought. Profitability is not just about profit. It's about how efficiently profit is generated. If you can truly master that one concept, you're not just going to pass a test. You're going to start looking at businesses exactly like a professional investor. So the next time you see a company bragging about some massive return on equity, you've got to ask yourself, are they truly an operational powerhouse, or are they just hiding behind a giant, dangerous pile of debt? Keep practicing those formulas, and I'll see you in the next explainer.